Alright, so in this video, I want to explain how you can boost your dividend yield on your favorite dividend paying stocks. So first, I'll give an example with an ETF that I own, IWM, which tracks the Russell 2000 index. And then I could look at some other examples on regular stocks like McDonald's, JP Morgan, Johnson & Johnson. So with my perfect timing, I ended up buying 100 shares of IWM at around 164 at the end of February before the crash. And here you can see my position. I've got an average price of 151 on IWM because I bought it a few times after when it dropped to average down my price to 151. But initially I bought it at 164 or 162, I believe. But then I bought 37 more shares at a much lower price. So that's why my average price is 151. So as you can see, I own 100 shares at 151.6, but I'm down $500 because the current market price on IWM right now is 146.59. So if I just bought and held IWM, I'd be down $500. It does pay a dividend, and I think I received dividends twice from it. Pays about 1.41% right now in dividend yield. But as you can see, I bought it at around here, and all this time that came after, it just never came back up above my initial purchase price. But while holding this stock, I was able to collect a total of $925 US. So not bad for about 4 months of holding a stock that I'm currently down on $500. So I'm down $500 on the stock, but I actually made $900 from the stock. So here's how. I downloaded the activity from Questrade, and it's sorted by transaction date, of course. So you can see that initially I bought 100 shares of IWM at, as you can see, at around 161. So 161, 162 was the price. And I sold immediately a covered call at a 164.5 strike. As you can see here, 164.5 strike. And you can see it was done on the same day. So all that means is I collect a premium of $76. That's mine. And in consequence, if the stock ends up above 164.5 come expiry date of February 28th, I lose my shares at 164.5. But I don't care. I bought the stock at 161. If I lose it at 164, I make a profit. Plus, I collected a $76 premium. So in fact, the stock actually dropped after that. So what I ended up doing on February 26th, so before 2 days before the expiry of February 28th, on February 26th, I bought back that call option that I sold for 76. I bought it back for $4, or I think that's just the commissions here. I bought it back and I sold the 164 strike, as you can see here. So I went from 164.5 to 164 for the March 6th expiration. I collected $53. And then my 164 strike that had a March 6th expiration ended up expiring on March 6th. So it's worth zero because the stock was obviously trading below 164 come March 6th. So if we go look at IWM on March 6th, you could see that it was trading at 144. So definitely 20 points lower than my strike. So what that means is I could have actually sold a strike much lower and collected more premiums than the $53 that I collected from the 164 strike. But of course, at that time, I don't know which direction IWM is going. I don't know if it's dropping or going higher. All I did was I make sure to sell a strike that is higher than the current market price to give myself a chance that the stock does not reach that strike, because I don't want to lose my shares at 164. Even if I lose it, I'm still okay. But if my goal is to buy and hold and keep it forever, keep the dividends, then I don't want to lose my shares. So the idea to give myself a good chance that the stock doesn't get called away from me, I pick a strike that's higher, of course, and only 1 week away. So there's a smaller chance that that happens. And even if it does happen, there is a way around it, which I'll get to shortly. So then when my 164 strike expired, I ended up selling on March 10th, ended up selling the March 13 expiration at a 142 strike, collected $28. So this one here, March 10th, I did this March 10th for the 142 strike. So let's go see where IWM was at March 10. So March 10, it was trading at 134. So while it was trading at 134, I picked a 142 strike. Remember, my cost is 161. I paid 161 for this stock. So I picked a 142 strike. So I collected $28. This is after commissions. So this is net of commissions. Now, obviously, I don't want the stock to go above 142 come March 13 because my cost is 161. I don't want to lose my shares at 142. But because the stock's trading at 134, what are the chances that it goes from 138 to 142 in a matter of 3 days? So that's why I go out of the money, which is basically picking a stock or a strike that is above the current market price. Current market price 134, strike 142, 3 days to go. I keep the $28. And then March 16, you could see that the March 13 expiration, the 142 strike, expired worthless. So I kept the premiums. I still own my shares. So March 16, I do it again for the March 20th expiration, which is the next Friday. So as you can see, I'm always going for the Friday expiration. So always 1 week covered calls. This time I sold the 125 strike, collected $19. Now let's go see where IWM was trading at March 16. So March 16, it was trading at 103.62. So I guess selling the 125 strike, you could say, is quite safe. I went with $19. I went with the 125 strike just to be extra safe. And the reason I was able to go that far is because obviously the market was crashing. So volatility is high, VIX is high, so premiums are high. I could have gone at a 120 strike and collected way more, or even 115 strike. But once again, my goal is not to get called away because my initial cost is 161. So I'm just okay collecting premiums. If I consider this a buy and hold position, then it's like an extra dividend. It's a boost to my dividends. I'm selling call options against my shares. It's called covered calls. And the only risk is, the only consequence is the strike that I chose. If it gets breached at expiration, if it is in the money at expiration, I lose my shares at that price. But depending on the approach, you can avoid getting called away. As you could see, I'm giving you an example with this ETF that I've been selling covered calls on for 4 months. So then, of course, March 23rd, it expired worthless. Let's go see what it was trading at March 23rd. March 23rd, it was trading at 99. This March 23rd, I think, was the lowest day, the worst day in March, the lowest point we've reached. So, of course, my 125 strike expired worthless. And then the following week, so then on March 23rd, I sold the March 27th expiration at a 116 strike. Remember, IWM was trading at 99, so I sold the 116 strike, collected $24. So let's see, March 27th, where was it trading at? I needed to be below 116 basically for me to be safe. So March 27th, it was trading at 112.56, so pretty close. And in fact, I think even during the week, it reached 116.81. So during the week, it surpassed my 116 strike. But then on Friday, it dropped below 116, so it ended up expiring worthless. My 116 strike ended up expiring worthless. So the next Monday, March 30th, I sold the March 31st. So that week had two expirations. It had one on Tuesday and one on Friday. I don't know why, to be honest, but whatever. I sold the 119 strike that week and collected $32. So this is 1 day away. And I believe, let's go see on March 30th what IWM was trading at. So March 30th, IWM was trading at 115. So on that day, I sold the 119 strike and collected $32. The next day, I also collected a dividend of $50. So that came for free without doing anything. So then, of course, on April 1st, my 119 strike that I sold March 31st expiration, my 119 expired worthless, as you could see here. And just to confirm, basically IWM was trading below 119 on March 31st expiration. So let's go see. So March 31st, it was trading at 114.46. So yeah, it did expire worthless. And I keep my premium again. So now I sell another one. So April 1st, I sell the April 3rd, which is the Friday of that week. I sell the 118 strike. I collect $15.29. So basically that week, I collected $32, $50, and $15, about $97 US from that ETF, from my position, by selling 2 covered calls and collecting 1 dividend that came naturally. I didn't have to do anything for that. And then obviously April 6th, you could see that my 118 April 3rd call option expired worthless because IWM was trading below 118 come April 3rd. So let's go see. April 3rd, it was trading at 104. So yeah, definitely below 118. So this one expired worthless. So on April 6th, IWM was trading at 112. So I sold the 118 strike. Okay, collected $20 on this one. But then April 9th, let's see what happened April 9th. So remember, my strike is 118. I don't want IWM to go above 118. So let's go see what happened April 9th. April 9th, IWM was trading at 123.72. My expiration is April 9th. So that's not good for me because it's trading at 123 while my strike is 118. That would mean that I would lose my shares at 118. I would sell my shares at 118. I can't do that because my cost is 161. So if I lose my shares at 118, I'm going to lose a lot of money. I'm going to lose 161 minus 118 times 100 shares. So even all these little call premiums that I'm collecting do not compensate for that big difference in loss. So I have no choice. I have to buy it back. So I bought back the 118 strike, the one that I sold here for $20. I bought it back for $647. But I didn't just buy it back. I immediately sold the next week's call option. So I bought back the April 9th expiration at 118. And I sold the 120 strike April 17th. So that's the following week. So I bought back the 118 strike April 9th. I sold the 120 April 17th, which is the following week. And I collected $693. So the net combination gives me a net credit of $45. I still collected a credit from doing this transaction, from doing this trade, from saving my call option from being exercised. I still collected $45. I go an extra week. I went 2 strikes higher. So I went from 118 to 120 and I collected $45. But now, of course, I need IWM to trade below 120 come April 17. It was at 123 on Friday, April 9th. I needed to drop below 120 by April 17. You could see that on April 15, so 2 days before April 17 expiration, I did something. So let's go see what happened on April 15. So April 15, IWM was trading at 117.8. So it was below the 120 strike. So I got lucky. It was trading below my 120 strike. But then April 17, you can see that I went to 122. But I took action early on April 15 when I was trading at 117.8. Here's what I did. I bought back my 120 strike. But then I sold for the next week. So I went from April 17 to April 24. But I also went from 120 strike to 124 strike. So I gave myself an extra 4 points of room. And the net combination gives me a net credit of $33. So once again, every week I'm still collecting credit by selling covered calls on my position, out of the money covered calls. Some weeks they expired worthless. Some weeks I had to buy it back and sell the next week's. Sometimes a little bit higher, sometimes only 2 points higher. So in this case, it was only 2 points higher. In this case, it was 4 points higher. But I also got lucky that it came back down. Otherwise, I would have been in trouble if it didn't come back down. If it just kept going higher every week at the same pace, then I would have been in trouble. But of course, no stock goes up 3% every week. That's the whole idea. A stock can gradually go up, but it's not going to go up every week by 3%. It's going to go up maybe 2%, then come back down 1%, and then up 3%, then down 1%, or down 2%, or maybe even down 5%. So it's really random every week. But that's the idea with out of the money covered calls every week, is you pick a strike that you hope does not get called away. And if it does, well, then you just have to buy it back and sell the next week's strike for a credit. Sometimes you'll even have to do it for a debit if you want to play it safer. Let's say I want it to go at a 128 strike. Let's say I want to sell the 128 strike instead of selling the 124. I could do that, but then I might not get a net credit. I probably will have to pay a small debit, but it might be worth it if you want to save your shares, and you'll just say that the debit that you paid is still better because I collected a lot of credits on the way. It's okay if I pay a small debit a few times just to keep my shares, but in the long run, I'm collecting more credits than I am paying in debits to roll my call option to avoid getting my shares called away. All right, so now I'm at a 124 strike, and then it expires April 24th. So you can see April 24th, I rolled it again. If we look at the price of IWM April 24th, I need it to be below 124. So April 24th, it was trading at 122. So it was below 124. I could have left it to expire worthless, but just to be sure, because it moves a lot in the same day, I bought it back for $3.75. And then I sold the 129 strike for the following week. So that gives me a net combination, a net credit of $32. So another credit. And I'm at a 129 strike when IWM was trading at around 122. So once again, pretty safe, 7 points away just for the following week. So this is May 1st expiration. So May 1st expiration, as you can see, my strike is 129. Let's go see what IWM was trading at May 1st, it was trading at 125.14, and I said my strike was 129. So definitely could have expired worthless. Instead, I took action. I bought it back. I bought it back for $1.75, and I sold the next one for $25 at a 135 strike. So I went even further, trying to make the trade safer, just in case IWM jumps up. Just in case there's a week where it jumps up. So I always try to go as far as I can, as long as I'm collecting a credit. I mean, I consider this as extra dividend, right? I mean, I'm collecting 2% per year, but this way I can collect way more than 2% per year in dividends. So I pick a faraway strike, especially since my initial cost is 161. That's why I need to make sure that my strike is pretty far from the current market price, because I don't want to lose my shares at a strike that's lower than my initial purchase price. If IWM is trading above my cost, then maybe I won't necessarily care if I pick a strike that's close to the current market price, because anyways, it's above my purchase price. I'm profitable anyways. I could just keep rolling for credit. But in this case, I have to make sure I'm pretty far, because I don't want to lose my shares at a price lower than my cost. So I'm at a 135 strike now with a May 8th expiration. So let's go see May 8th what the stock is trading at. So May 8th is trading at 132. My strike is 135, so I'm good. I'm safe. I buy back on Friday. I buy back for 275, and I sell the next week's call option for 139. So I keep going higher just to give myself more room for error, and I collect a net credit of $34. And now my new strike is 139 with a May 15 expiration. So 139 May 15, let's see what it's trading at. May 15, it's trading at 125. So once again, another safe trade. Stock has dropped actually, so that means I could have gotten more if I went with a lower strike, or even if I had gone with a 135 strike again. But my idea is just to play it safe, just keep collecting income and make sure I don't get called away. Regardless, I bought it back for $1.75. I could have let it expire worthless, but I wanted to sell right away. So I bought it back for $1.75, and I sold the 134. So this time I went lower. Now I'm coming back lower because the stock has dropped a lot. Remember, the stock is trading at 125 now, so I'm still 9 points higher. So I went back down to 134, collected a net credit of $28, and now my new expiration is May 22nd with a 134 strike. Now let's go see what happened on May 22nd, where IWM was trading at. So May 22nd, it's trading at 134.89, and we said that my strike was 134. So it's above my strike on May 22nd, but not by much, by 89 cents. So for sure, I'm going to have to buy it back. So I do buy it back. So that option that I sold for $30, I bought it back for $66. But I immediately sold the 139 strike for May 29th for the following week. So the net combination here is still $33. So by buying back and selling the next week's, I collected a net credit of $33. And my new strike that I have to worry about now is 139 and May 29th. So let's go see May 29th, 139. What happened? So May 29th, I needed it to be below 139. It's trading at 138.9. So once again, very close. So most likely I'm going to have to buy it back again. Not for much, but I ended up buying it back. So you could see that the May 29th here, I bought it back for $8.75. But I sold then the 147. So I went pretty far. I sold the 147 strike June 5th, collected $22. So the net combination here is only $13. So this time was much lower, but because I wanted to play it safe. So now I have to worry about June 5th expiration and 147 strike. So let's go see on June 5th where IWM was at. IWM was at 150. So it's above my strike of 147. Let's see what I did. So of course, I had to buy it back. I bought it back for $474. But right away, I sold the 148 strike on June 12th. So I bought back the June 5th 147 strike for $474, but I sold the 148 strike for June 12th, which is the following week, for $538. So the net combination, the net credit is $63. So I still made a credit of $63 by selling the 148 strike. And I did this on Friday, June 5th. So now my new strike that I have to worry about now is 148 with a June 12th expiration. So let's go see what happened on June 12th. So June 12th, the stock is trading at 138. And remember, I said my strike is 148. So it ended up being safe, but I took action early. I took action June 10th, probably because I saw the stock go up. So let's go see what happened June 10th. So June 10th, the stock was trading at 146. In fact, even June 9, it was trading at 150. So on June 10th, it was at 146. So what I ended up doing is I ended up buying back the call option because I was worried about the 148 strike. I ended up buying it back, and then I sold the 150 strike for June 19. So now that it's a net combination of $29, net credit of $29. I bought back the 148 and I sold the 150 once again for a credit. I went 2 strikes higher. So now I'm even further. I've got a 150 strike, but I've got a June 19 expiration. So now I need IWM to trade below 150 come June 19. So as you can see, sometimes it gets really close, but sometimes you have a lot of breathing room and it just expires worthless. So now I'm worried about the 150 for June 19. So let's see what happens. But you could see on the following line that I took action June 15. So let's see what happened on June 15. So June 15 is trading at around 141 and my expiration is June 19. So June 15, I ended up buying the 146 strike for $44. So now I'm worried about the 150 strike for June 19. So if we look at June 19, we could see that it was trading, it ended up closing at 141, so way lower than 150. And you could see that what I did on June 15, if you look at this line here, I ended up buying back the 150 strike on the same week. So June 15, I bought back the June 19 expiration 150 strike. And then on the same day, I sold the June 19. So same expiration, I sold the 146 strike. So because I saw IWM drop a lot, I decided to bring my strike lower, collect more credit. So there's a net credit. So I collected $28 on this combination of trade. So this one here collected 29 and then another $28 here. So combined, it gives me a total credit of $58. Basically, I rolled from 148 to 150. And then when IWM dropped in the same week, I rolled down from 150 to 46, thinking that 146 is safe enough. I could still sell the 146 for June 19. I have 4 days to go. I think it's safe enough. It won't get called away. And on June 19, we saw that it closed at, I forgot already, but it closed at 141. So it ended up being safe. So then, of course, I got a dividend on June 19. So that's good. We forgot about the dividends, but I got one of $63. So pretty good. And then obviously my 146 strike, my 146 call option that I sold at a June 19 expiration ended up expiring worthless. Okay. So now I can sell a new call option. This time I picked a 149 strike, collected $32 for June 26th expiration. It ended up expiring worthless because IWM was trading below 149 come June 26th, and we could see on June 26th, we want IWM to be below 149. Yeah, it was at 136. So I sold another call option for July 2nd expiration at a 146 strike, collected $25. And that one as well expired worthless on July 3rd because it was trading on July 2nd, it was trading below 146. So then on July 6th, I sold a 151 strike and collected $28 again. And then that one obviously expired worthless because IWM was trading below 151 come July 10th. And we can go see that. July 10th, where was IWM? July 10th, IWM was at 141. So definitely below my strike of 151. So that means I could have gone lower. I could have chosen a lower strike and collected more premium. So I ended up selling the 148.5 and collected another $30. Now remember, my cost initially was 161, but because I bought shares several times after that, my net cost is about 151. So now we're getting close to my cost. So now if my shares get taken away at 151, I'm not going to care that much because I've collected a lot of premiums on the way while holding this stock. But if my goal is to keep my shares forever, then I want to make sure that my strike is always as far as possible from the current market price. So an out of the money strike. So this week I ended up buying back. So July 17, I bought back the 148.5 strike, which would have expired worthless. I bought it back and I sold the 152 strike. And now the net credit is $63. So now I'm actually a little bit closer. I could have gone way further than 152, but my cost is 151. So I didn't care if my shares get called away at 152. In fact, I want to sell my shares now. I don't want to keep it anymore because I find IWM to be a little bit slow compared to the SPY and the Qs. So I'm just trying to collect as much premium as possible from the 152 strike, which is my cost right now, my net cost. And when it gets too far, when it gets too high, then I'll just sell my shares. But I've collected enough premiums to make this trade worth it. So you could see that I've collected about $925 US in premiums by holding this stock. And even though all it did is drop all the way down to 99 or even lower and come back up to 150, 146. So it's trading below my cost, and I still managed to make $900 from the stock. And that's from selling call premium, selling call options against my 100 shares. Now you can only do this with multiples of 100 shares. But as you can see, most of the weeks were fine, were easy, no stress because they expired worthless. But some weeks, yes, I got tested, so I had to buy it back. But then I just sold the next week's call option at a higher strike. So I got lucky a few times that even though my call option got breached, that the following week it dropped below it and I was able to recover. So it does come with a little bit of risk, but it's definitely worth it if you want to increase your dividend yield on the positions that you're holding long term. And this is a perfect example. Now I was doing this with the Qs. I had an average price of 221. The Qs just got way out of hand at a 213 strike. It just kept going higher and higher, and I couldn't catch up, especially that I was trying to roll for a credit. If I accepted to roll for a debit and to always pick a strike that is out of the money for the following week, maybe I could have saved it. But I ended up closing my trade at 213 while my cost was 221. So this was an example where I lost money on the shares, but I collected enough premiums on the shares by selling call options. I collected enough premiums to compensate for that. So I don't really care. If you're someone that wants to keep your shares forever, then something like the Qs would have been bad because the Qs was just flying, which obviously is not typical behavior. I mean, every week it was going up 3 or 4%. So I couldn't catch up with my covered call rolling. But in general, stocks don't go up like that. Individual stocks don't go up that fast every week. It'll go up gradually, some weeks up, some weeks down. So this is one of us. I'm gonna look at McDonald's because this is a stock that I'm always considering buying for dividends and doing covered calls on at the same time. So right now, McDonald's at 191. A possibility would be if I buy 100 shares at 191 and I want to increase the dividend on it. It pays about a little bit less than 3% right now. But if I want to increase the dividend, I could sell a July 24th, which is the next Friday, so 1 week expiration. I could go ahead and sell maybe the 200 strike, collect $26, or maybe sell the 197.5 strike, collect $45. And that's how, or even more actually, something between the bid and the ask. So the last price was 55 cents. So that would be a way to increase my yield on my existing positions or on my dividend stocks. And if McDonald's does end up going above my strike, well, then I'll just have to buy back that call option. So I'll buy, let's say I sold at 200 and McDonald's would end up going over 200. So from 191 to 200 in 1 week, which doesn't normally happen, but if it does, then I have two choices. I'll have to for sure buy it back, but then I can sell the next week's option. So I can sell the next week's option here, for example, July 31st. I can either sell at the same strike or I could sell at a higher strike. But the idea is to make sure that the premium collected from the following week minus the premium paid from the existing week ends up being a credit. Or if I want to make the trade safer, I could pay a little debit just to make sure that the next week's strike does not get tested. So McDonald's goes from 191 to 200. So I want to save the trade. I want to keep the shares. So I buy back the call option at 200, but then I sell the following weeks at a maybe 205 or 207.5 strike. Maybe I'll collect the credit. Maybe I won't, but at least my next strike is completely safe, and then I could do it again for the following weeks. JPM has also good premium, so I could buy 100 shares of the stock at 98, so that's $9,800, and I could sell the out of the money call option, let's say at 104 strike. So as long as it stays below 104 with an expiration of July 24th, then I keep the premium, or I keep my shares, and the premium I collected anyways, but I make an extra premium of $33 or $41 if I take the 103 strike. So that's the general idea, is just to sell out of the money covered calls on your positions to increase your dividend yield. And if you do get tested, well, then you have the choice to buy back and sell the next week for a credit or even for a debit if you want to make the trade safer. So if you have any questions, please leave them in the comment section below. I mean, I've given you examples to see how it works. Now, if you're using Questrade, if you want to sell a call option, you have two choices. If you already own the stock, just have to sell the option on it itself. So let's say I go to McDonald's and I just want to sell the call option because I already own 100 shares, and I'm going to look up the calls. I'm going to choose my expiration. I'm going to choose my strike. Right now, market is closed, but I'll click buy and sell and then pick my strike, put my price over here, and then I'll click on sell. Then I'm going to get an order confirmation window, and I'm selling to open against my 100 shares. It's not a naked call. It's going to be a covered call because you own the 100 shares. So just make sure you're in the right account that has the 100 shares. If you don't already own the stock, then you look up the stock under options, but then you're going to choose covered call. Because with this option strategy here, you're going to be buying 100 shares and selling the call option at that strike that you choose at the same time. So it becomes one trade. So for example, I click the 202.5, click buy and sell, and you can see that it gives me right away buy 100 shares, sell the July 24th 202.5 strike, all in one trade. And then once you own the position, the covered call position, you're going to see, and you group your positions by strategy, you're going to see your shares, you're going to see the covered call below, which is a -1 because it's a call it's an option that you sold. If it's out of the money, you can let it expire worthless. If it's in the money on expiration and you want to save the shares, then you're going to have to buy it back. And if you want to buy it back, you simply click create order. You remove shares. You want to buy back the call option, and then you can roll it. You can sell the next week's July 31st, for example, at the strike of your choosing. So let's say 150, 155. If you can go higher, it's always better. And then it'll, at the bottom here, it'll give you the net credit. You simply just put the net credit that you want and you click send order. And that's really basic. And it's as simple as that. So if you are going to open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back, depending on your deposit. The other one gives you $50 in free trades, regardless of your deposit. Make sure to check out my Teespring store with t-shirts with some funny phrases. Help support the channel. Link is provided below. And if you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.